Welcome to Real Sticks Guy, where the stuff you never learned finally makes sense. Real tips, real talk, and a whole lot of laughs because learning should never be boring. Let's get started. Zillow just sent up a giant red flare. Their latest forecast? It shows home prices dropping in 242 cities. Not slowing, dropping. And if you think this is just a blip, think again. Because when the most optimistic real estate platform slashes its projections by 80% in just 2 months, that's not a fluke, that's a flashing warning sign. Now, why should you care? Because whether you're buying, selling, investing, or just trying to figure out if you'll ever afford a home, this shift could mean the difference between scoring a deal and walking into a financial trap. You might even be in one of these markets right now, watching your home value shrink like a sweater in the dryer. So let's break it all down, what Zillow's really saying, what they're not saying, and how to play this next phase of the housing market like a pro. And stick around, because by the end, you'll know exactly how to avoid the mistakes that could cost you a small fortune. Okay, back in January, Zillow predicted home prices would grow about 3% in 2025. Not amazing, but decent. Fast forward to March, that number got nuked down to just 0.6%. That's basically flat when you factor in inflation and margins of error. And that's national, meaning in some places prices are still creeping up, but in others they're already sinking. And guess what? Zillow says prices are set to fall in 242 cities. That's nearly a quarter of the country's housing markets. Imagine opening your favorite home app and watching your property's value tick down month after month like it's on a slow-motion elevator ride to the basement. That's where a lot of homeowners are headed, and most don't even know it yet. You might be wondering, is this just fear-mongering? Here's the twist. Zillow is usually the sunshine and rainbow's forecaster. They tend to downplay risk. So when they start flashing warning lights, you better believe the storm's already rolling in. And where's it hitting hardest? 5 states: Texas, Florida, Colorado, Arizona, and Utah. These places were pandemic boomtowns. Everyone wanted in. Now, they're leading the drop like the front row of a roller coaster about to take a dive. Let's look at Texas. Austin's market has gone from hot to ice cold. Listings are sitting. Price cuts are everywhere. Inventory? Up 68% year over year. That's a big deal. When inventory shoots up and buyers dry up, guess what happens? Prices fall. And quickly. Same story in Florida. Inventory has exploded. Investor demand has vanished. Miami, Tampa, Orlando, all seeing massive increases in listings and big jumps in price cuts. And it's not just individuals pulling back. Institutional investors, the big guys, have bailed too. When the hedge funds run, you know something's up. In Colorado, Denver's days on market jumped from 9 to 38. That's 4 times longer to sell a home. Meanwhile, pending sales are falling. That's a gap, and gaps turn into price drops. Buyers aren't biting. Sellers are sweating. Arizona, investor playground during the boom. Now it's ghosting season. Phoenix has 4.2 months of supply. Investor sales are down over 50%. Nearly half the listings are seeing price reductions. It's like an online sale that nobody showed up for. Utah's seeing similar pain. Salt Lake City has tripled its days on market. New construction is piling up. Builders are scrambling to offer deals. It's like a giant game of housing hot potato, and no one wants to be stuck holding the bag. And here's what ties all these states together. Investor speculation. During the boom, investors were scooping up homes like candy, nearly 30% of all purchases in these markets. That's way above the national average. Now, those same investors are trying to dump inventory fast. And it's not just the big picture. It's happening city by city. Austin down over 7%. Boise, 6.8. Phoenix, 6.3. Tampa, over 5. These aren't tiny towns, they're major metros, with huge equity at stake. And then you've got the moderate and mild decline cities. Think Denver, Nashville, Orlando, Dallas, Atlanta. Not crashing, but sliding. That adds up too. When you zoom out, it's clear that this isn't an isolated thing. It's a trend, a correction, and it's moving quickly. So what does all this mean for you? Well, if you're thinking about buying a home, especially in one of those 242 markets, timing could save you tens of thousands. Let's say you're eyeing a home in Phoenix priced at $450,000. With a 6% projected drop, That's 27,000 bucks you could save by waiting. That's like getting a brand new kitchen for free or avoiding years of being underwater on your mortgage. And it's not just about the price tag. It's about what you can do with that money. That could be your down payment, your renovation budget, or even your emergency fund. Real savings, real options. Second, the negotiating table has flipped. Sellers no longer have all the leverage. In many cities, buyers are getting deals below asking. They're asking for repairs, closing credits, even contingencies that were off limits just a year ago. You have options now that simply didn't exist during the frenzy. It's like walking into a car dealership and knowing they need the sale more than you do. Third, location matters more than ever. While many markets are dropping, others are still holding up. The Midwest and Northeast cities like Cleveland, Pittsburgh, Buffalo didn't get swept up in the frenzy. So now, they're not crashing. In fact, some of these markets are showing slight price growth, slow and steady. And in this climate, that's not a bad thing. Fourth, mortgage strategy is changing. With the Fed hinting at rate cuts, adjustable rate mortgages arms are suddenly back on the radar. Some buyers are locking in lower initial rates and planning to refinance later. It's not for everyone, but if you understand the risks and plan smart, it could make your monthly payments more manageable. Fifth, and this is big, the return of contingencies. During the boom, buyers were waiving inspections and appraisals just to compete. Now, you can protect yourself again. And in many cases, sellers are okay with it. In fact, they expect it. You have leverage. Use it. Now, what if you're investing? This new landscape demands a total strategy shift. Cash flow matters again. The buy it and it'll go up days are done. If your investment doesn't pay you from day one, it's probably a bad bet right now. Flipping? That's risky business in a falling market. Imagine buying a fixer-upper in January, sinking 40 grand into renovations and trying to sell it in July, just as the local market drops 5%. You're already in the red before you even list. Buy and hold investors need to be picky. Look for markets with job growth, low inventory, and solid rental demand. Charlotte, Columbus, Indianapolis. These places still have decent fundamentals. Foreclosures are also ticking up, especially in Florida and Texas. That means more opportunities if you know what you're doing, but also more pain for over-leveraged owners. And here's a surprise twist. While single family is cooling off, some parts of multifamily are stabilizing, especially Class B and C properties, the more affordable rental buildings. If you're looking to pivot, that might be your move. Also, don't overlook alternative real estate plays. Things like private lending, real estate debt funds, or even fractional ownership platforms. These can help you stay in the game without overexposing yourself to declining single-family values. Zillow's forecast is a wake-up call, not a panic signal, but a reality check. After years of wild price gains, we're seeing the beginning of a correction. Not everywhere, not all at once, but fast enough to matter. So here's your takeaway. If you're buying, be patient, be smart, and don't skip due diligence. If you're selling, price it right, fast. If you're investing, cash flow is king. And if you're just watching from the sidelines, now's the time to learn everything you can, because this market is shifting under our feet. And yeah, it's easy to feel overwhelmed. But here's the good news. These kinds of corrections clear the way for opportunities. Less noise, more realistic prices. And if you're prepared, you'll come out ahead. Want more breakdowns like this one? Hit subscribe, drop a comment, maybe even share which city surprised you most, and check out our next video. Is Texas the next 2008? Why this crash feels different and bigger?